Hello, everyone. Connor Darrell here from the WealthSpire investment team with another edition for our Markets in 2 Minutes series. One recent topic that's come up a lot for us in talking with clients and colleagues is China. China's economy and equity market has been suffering a bit this year as a result of continued COVID-related lockdowns and weakness in its real estate market. And on top of that, there's been an increase in geopolitical tensions with respect to Taiwan and China's efforts to intensify its technological rivalry with the United States. And so we thought it would be helpful to try and provide some perspective around the role that China plays in the context of a globally diversified portfolio. Because obviously, China is a major player on the global scale. But what's surprising to some people is that when you look at Chinese equity markets relative to the rest of the world, the exposure is actually relatively limited. This table shows the share of global GDP as well as the share of equity market cap for several different countries and regions around the world. And what immediately stands out is that China constitutes close to 20% of global GDP, but only has a 5% share of global equity markets, which is a rather large difference. And we find this to be a helpful thought exercise for US-based investors who have seen some of the recent headline risks that have emerged out of China and might be concerned about the exposure that they have in their portfolios. And one other way to look at this is to look at revenue sources for large cap companies. On the left-hand side is the top 10 countries in terms of where revenue is sourced from for companies in the S&P 500. And the right side is the same illustration for companies in the MSCI All Country World Index, which is just a basket of global stocks. And the message here is directionally similar, right? Even despite the size of the Chinese economy and the emergence of the Chinese consumer in recent years, these numbers are still down in the 10% range, which is certainly lower than some might expect. And this is, of course, an area that we intend to keep close focus on. But what we most wanted to articulate with this particular video is that, yes, we have seen an increase in both geopolitical and economic risks emerging out of China, but the direct exposure for broadly diversified investors remains pretty low at this point in time. And so with that, I'll wrap everything up here and leave you with a quick reminder to keep checking back with us for future updates. Thanks for tuning in.